4% of a $1 million nest egg pays you $3,333 a month. 7% of that exact same $1 million pays you $5,833 a month. Same account number at the top of the statement, same balance, same Tuesday morning deposit. $2,500 apart. And if you've already been retired 3 or 4 years, neither of those is the rate you're actually running right now. It moved without anyone telling you, and by the middle of this, you'll be able to check yours in about a minute with a calculator app. There's also a small problem with the smaller of those two checks. The 4% figure is a rounded worst case. And the man who calculated it has since revised it upward twice, in public, with his own data. I will get to exactly what he now says, but not before both checks are on the table, because the two numbers I gave you are gross, and neither of them is what lands in the account. So take the after-tax version, married couple, both retired, money sitting in a traditional individual retirement account, no state income tax, 2026 federal rules, standard deduction of $32,200, pull $40,000 for the year, and your taxable income is $7,800. All of it inside the 10% bracket. Federal tax, $780. That is under 2% of the whole withdrawal. What lands is $3,268 a month. Now pull $70,000, taxable income of $37,800. 10% on the first, $24,800. 12% on the rest. Federal tax, $4,040. That is 5.8%, roughly 3 times the effective rate the smaller check pays. What lands is $5,497 a month. So cross out the $2,500 gap. The real spread between a 4% life and a 7% life on the same $1 million in the account is $2,230 a month. $270 of the advertised gap evaporated before a single market risk entered the conversation, because the bracket structure leans on the bigger check and barely touches the smaller one. That is the title question answered, and it took under 3 minutes. Which means the interesting part is the thing sitting underneath both figures, and it is not a dollar amount at all. Neither of those checks is a salary. A salary is a fixed claim on someone else's revenue. These are percentages of a balance that moves every single day, and the dollar is the part that stays still while the percentage does not. $3,333 a month against $1 million is 0.33% of the pot leaving every month. $5,833 is 0.58%. That second gauge is the number almost nobody tracks, and it is the one that decides whether the check survives. Speaking of things nobody tracks, I put the full version of this arithmetic, the drain rate and the rules that keep it inside a safe band, into a digital book called The Exit Code. Link is in the description if you want the worked version rather than the spoken one. Back to the gauge. Because here is why that percentage matters more than the dollar. When you look at every 30-year retirement window in the American record and ask what actually predicted whether the money lasted, the first year of returns barely registers. The correlation between year 1 returns and the sustainable withdrawal rate is about 0.21. Weak. Almost noise. But consolidate the view to the cumulative real returns of the first 10 years, and that correlation jumps to about 0.79. Sit with what that means for your own calendar. Your retirement is not decided across 30 years. It is decided in the first decade, and mostly in the first few years of that decade, while you still feel like you are settling in. Everything after that is largely bookkeeping on a result that has already been set. And the reason the front decade carries that much weight comes down to arithmetic you can do on the back of an envelope. Take the 4% retiree, $40,000 out over the year leaves $960,000. Now, the market has a 30% year down. $960,000 becomes $672,000. Take the 7% retiree, same market, same start, $70,000 out, leaves $930,000. The same 30% drop takes it to $651,000. $21,000 apart. And your reaction to that is probably the correct one. $21,000 on portfolios this size after a crash that ugly is nothing. It is a rounding error. which is exactly why the damage is invisible, because the damage is not in the balance. Go back to the gauge. $40,000 a year against $672,000 is 5.95%, 0.50% a month. That retiree is now drawing at a rate meaningfully higher than the one they chose, and their plan is under strain. $70,000 a year against $651,000 is 10.75%, 0.90% a month. Read that again. The 7% retiree is now running a 10.75% plan. They did not decide that. They did not sign anything. They did not increase their spending by a single dollar. The check on the bank statement is identical to the one from December. The rate underneath it nearly doubled in 12 months, and nothing in their account will ever tell them so. That is the whole reason withdrawal rate is a misleading phrase. It sounds like a setting you control. It is an output. You control the dollar. The market controls the denominator, and the denominator is where you live now. And the instinct at this point is to assume a good year cancels a bad one. It does not, for two separate reasons. First, a 30% loss requires a 43% gain to get back to even 1 divided by 0.7. That is not opinion. It is a property of percentages, and it means recovery is always a longer climb than the fall. Second, order destroys money, even when the average says it should not. $1 million up 30% is $1,300,000. Down 30% from there is $910,000. The arithmetic average of those 2 years is exactly 0, and you are $90,000 poorer. Reverse the order and you get the same answer, because the losses compound against the base, the gains already inflated. Add withdrawals to that, and you are selling shares at the bottom to fund the deposit shares that are then not present for the recovery permanently. Now let me give the 7% argument its strongest form, because it is not stupid, and if you only hear it strawmanned, you will never trust the answer. The case is this. Over the long run, stocks have delivered somewhere around 6.5 to 7% per year after inflation. That is the purchasing power growth of the engine. So a 7% withdrawal is not eating the nest egg. It is harvesting the growth and leaving the capital intact. On paper, that is coherent. On a spreadsheet with one growth rate typed into one cell, it works perfectly. The flaw is that no retiree ever receives the average. You receive your own sequence in your own order once with no rerun. The average is what shows up in the textbook after you are dead. During the withdrawal phase, the order is the entire story, and the front decade is where the order does its damage, which is precisely why that 0.79 correlation exists. Which brings you to the part that people misunderstand about failure. The 7% check is almost never canceled by a decision. Nobody sits the retiree down. What happens is that the check gets repriced by arithmetic. Once you're drawing at 10.75% of a shrunken pot, one of two things has to give. Either the market hands you an extraordinary decade to bail you out, or the check comes down. And when it comes down in the worst year, from a smaller base, by more than you would have chosen, at an age where your options for replacing income have quietly disappeared. Compare the two positions honestly. The 4% retiree at 5.95% has a plan under pressure that can probably absorb a few flat years. The 7% retiree at 10.75% has a plan on a countdown. And the countdown is running whether or not they look at it. By the way, clicking subscribe genuinely helps this channel, so thanks to everyone who does it. Because now I have to take the safe answer away from you too. The 4% number was never a description of a normal retirement. It was engineered around a disaster. William Bengen tested every 30-year retirement window in the historical record, roughly 400 starting scenarios, and asked one question. What starting rate would have survived the single worst one? That worst one was a retiree who walked out of the office in October of 1968 and into a bear market, a crash, and a decade of inflation, in that order. The rate that saved that one specific person became the rule that governs every retirement calculator on every bank website in the country. And Bengen has not left it there. In his updated work, he raised the worst case figure to 4.7%, the rate that would have carried even the unluckiest start date in the record. So the floor moved. But that is only the first of 3 numbers from the same man, and the other 2 are the ones that break the frame. The second is what the typical scenario supported. Across those 400 starting points, only the 1968 retiree needed something near the low number. The average maximum safe rate across the whole set was about 7.1%. The third number is his own suggestion for a retiree starting today, which sits around 5.25 to 5.5%. Put all 3 on your ledger, same $1 million, gross. 4.7% is $3,917 a month. 5.5% is $4,583. 7.1% is $5,917. 3 markers, 1 researcher, 1 data set. A spread of $2,000 a month inside a single body of work. So there is no rule. There never was a rule. There is a range, and the 4% you built your entire mental model around is sitting near the bottom edge of it, describing a starting date from 1968. And a disagreement is not one contrarian against the establishment. Morningstar's retirement income research for 2026 puts the safe starting rate for a fixed inflation-adjusted withdrawal at 3.9%, lower than 4%. On your million, that is $3,250 a month gross. The same research, same report, same markets says a retiree willing to adjust their spending can start at 5.7%, $4,750 a month. 1 institution, 1 publication year, $1,500 a month apart. That gap cannot be explained by optimism or caution or different forecasts, because it is the same forecast. Something else is producing it. Here is what. Jonathan Guyton and William Klinger published a set of mechanical decision rules in 2006 and tested them against every market environment since 1928. With at least 65% in stocks, they found initial withdrawal rates of 5.2 to 5.6% held at 99% confidence over 40 years, not 30. Drop the stock allocation toward half, and the sustainable figure falls back toward 4.6%. Notice the shape of that. The longer horizon license, the higher number. That is backwards, unless the variable being tested was never the horizon at all, and it was not. The rules are what changed. If your current withdrawal runs about 20% above the ratio you started at, the check comes down 10%. If it runs about 20% below, the check goes up 10%. That is the entire apparatus. No forecasting, no market timing, no judgment call in the middle of a panic. What those triggers actually buy you is one thing. You are never the person selling shares at 10.75% of a crashed portfolio during the decade that decides the outcome. The high numbers in the research assume a retiree who moves. The low numbers assume a retiree who is frozen. That is the whole spread. It was never 4 versus 7, it was fixed versus moving at 2 different volumes. Knowing these numbers and running a system built on them are 2 different jobs. And the second one is where people stall out. That is why I built the Exit Code, a digital book that takes 50 years of actual retirement data and compresses it into a mathematical framework for leaving the working world on a date you can name. It goes deep on 2 things that matter directly to what you have been watching. The 4% trap, which is the mistake of treating a worst-case floor as a lifetime ceiling, and the dynamic withdrawal method that replaces it, the trigger levels, what to cut, when to raise, and how to size the check against a balance that will not sit still. 8 chapters, research, no filler, no product recommendations. It costs less than a dinner out, and you can get it through the link in the description. Now, the part that book spends a chapter on and that we have not put a dollar on yet. What does a moving check actually pay you each month? Take the middle of the guardrail band, 5.4%. On $1 million, that is $54,000 a year, $4,500 a month gross. Run it through the same tax assumptions as the first 2 checks. Same couple, same account, same deduction, and federal taxes, $2,180 for the year. What lands is $4,318 a month. Run the edges of the published band and you get a floor of about $4,168 and a ceiling of about $4,468 net. That is not a new study and is not my invention. That is arithmetic on someone else's published range using the current tax table. Against the 4% check, that is roughly $1,050 more in your account every month. Against the 7% check, it is roughly $1,180 less. A third paycheck on the same nest egg, and neither number in the title produced it. And it is not free, so let me price the ugly side. When the guardrail fires, a 10% cutoff $4,318 is $432 a month gone. $3,886 lands instead. That cut arrives in a year the market has already fallen, which is the year you least want a pay cut, and you will feel every dollar of it. The trade is that the cut is small, decided years in advance while you were calm, and taken from a portfolio still large enough to recover. The alternative is a cut that is large, forced, taken during the countdown, and permanent. So both premiums are now quoted. Staying at 4% costs you about $1,050 a month, forever, as insurance against a starting date as bad as the worst one in the record. Reaching for 7% buys you about $1,180 a month in exchange for the right to be forced into that involuntary repricing later. You can now actually choose, which you could not do at the start of this. And it is worth being clear about why the 4% version got fossilized, because it is not villainy. An advisor charging 1% of assets under management has a fee that scales with the balance in the account, and a client whose portfolio runs out is a catastrophe for them in every direction, professionally, legally, personally. A conservative rate protects the client and the practice at the same time. Nobody had to lie for 4% to become dogma. The incentive did all the work quietly, and most of the people repeating it believe it. Two things still move your personal number. The first is where the money sits. Everything so far assumed a traditional individual retirement account, where every dollar out is ordinary income. Run the same withdrawals out of a taxable brokerage account, and long-term gains are taxed at 0%, up to $98,900 of taxable income for a couple in 2026. Both checks largely escape federal tax, and the gap between them widens back toward the full $2,500. That tax bite you watched land on the bigger check was mostly a feature of the account type, not of the rate. The second is your age. For a couple where both spouses are 65 or older, the additional standard deduction and the temporary senior deduction available through 2028 stack on top of the base, pushing total deductions to roughly $47,500. At that level, the 4% check pays no federal tax at all. The 7% check pays about $2,250, and your real monthly gap moves to about $2,313. State tax, a pension, or Social Security timing will each shift your figure again. None of them change the shape of anything you have seen, which leaves one force acting on these same two checks, and it is not financial. It is what the money is for. Real retiree spending does not run flat for 30 years. David Blanchett's work on actual household expenditure found real spending drifting down roughly 1% a year. So a household starting retirement spending $100,000 a year reaches a trough around age 84 at about $74,000. In today's money, a drop of nearly 26% before health costs push the curve back upward. Both title rates are built on a straight line that describes almost nobody. Now collide that with everything else. The extra $2,230 a month buys the most in your first decade, when you still travel, still drive at night, still say yes to things. That is the same decade that carries the 0.79 correlation. That is the same decade where a 10.75% draw is lethal. By the trough at 84, those extra dollars are landing on a life that is spending a quarter less in real terms. They buy storage, not Tuesdays. So the extra money is worth the most in exactly the years where taking it does the most damage. That is the entire argument in one sentence, and it is why the honest answer is a check that starts higher than 4% and is allowed to move. Which means your job description changed the day you stopped working, and you were probably not told. For 30 or 40 years, your job was accumulation, and the reflex that made you successful at it was rigidity, the automatic contribution, the untouched allocation, the refusal to react to headlines. Not flinching was the skill. In the withdrawal phase, not flinching is the failure mode. The new job is running a variable claim on a moving balance, and the retiree who will not adjust is applying an accumulation reflex to a decumulation problem. Staying in the old role costs about $1,050 a month if you stay frozen at 4, and costs the plan itself if you freeze at 7. I've got a solid 6 figures in the market myself, and a decade of running my own business surrounded by accountants who explained this to me in language I did not enjoy. Lazy investing built more fortune than crypto memes, and the laziest possible discipline here is checking one fraction once a year. So take your balance today, take your annual withdrawal, divide one by the other. If that fraction has drifted about 20% above where you started, your check needs to come down 10% this year. If it has drifted 20% below, take the raise, you have earned it, and the data says you can afford it. The retirement that fails is not the one that spent too much. It is the one that never looked.